This is an educational podcast, and whatever we would be discussing are individual views, and in our limited capacity, we try our best so as to educate you guys. So please take the session as a learning point or starting point. And on the top of that, if we discuss anything, so that should not be construed at buy, sell, or hold recommendation. That has to be taken care by your financial advisors, or you yourself can take your decisions, because you never know what mindset we have when we are discussing things, and your risk profile and everything is altogether different. So this is second session with Viraj, and it was a wonderful session first time. So those who are yet to have a look at, so definitely they can listen to the conversation on my YouTube channel. I'll be sharing the link again with Viraj. And today we'll be discussing a very important aspect, risk of momentum investing. So, Viraj, I would request you to start with your introduction and then perhaps some overview of the last session, so that those who were not there that time can get the gist of the session, and then we move on to today's topic of risk management.
Sure, no problem. Thank you, Prince. So the first thing, I just wanted to apologize because yesterday night I just got a bad bout of cold and my voice will be a little bit different today, and I might be taking some pauses in between to drink water because of the cough that I'm having. But otherwise, it's good. So to introduce myself, so my name is Viraj Khatavkar. Education wise, I've been an computer science engineer. I am not a full-time investor yet. I still work at a day job. So I do this for my equity portion. Uh, so I started into the markets during the bull market of 2017. So it's been a wonderful 6 years. I made a lot of mistakes, lost a lot of money, and eventually I settled on momentum investing. I have been working with some aspects of momentum investing since 2019, but I never really committed to it. I basically started committing to momentum investing in I think around 2020, end of 2020, something there. Uh, so I basically liked the idea of the whole momentum investing strategies and all that stuff, and I basically started committing more and more capital to it. Right now, the situation is that all of my equity portfolio is into momentum investing. I don't have anything else, just my ELSS funds, and rest of all my equity portfolio is with momentum investing. So it's like I have all my legs in this strategy. But the main important part is only the equity allocation. I maintain my asset allocation, and the rest all things are taken care of. But all my equity allocation is towards momentum investing. So this was like a short intro for me, how I got into momentum investing and stuff, and how my current allocation looks like. As Prince said, just to give you a gist of summary of the last session, what we discussed was overall the general introduction to momentum investing. So obviously, as Prince said, you can listen to the longer version on the YouTube channel, but to give you a summary in like 2 minutes, this is what we all discussed in the last session. So we went over what momentum investing was. We discussed various things that we can use to define a momentum criteria, like returns across last 12 months, closer to 52-week high or closer to all-time highs. What are the different filters that we can use? How momentum investing has performed in various markets, including the US and EU markets, how it has performed in the Indian markets and stuff like that. So we discussed all this in detail in that session. We also went into some nuances like how different filters might affect your strategy and how adding or subtracting filters might make your strategy more robust or more prone to errors and stuff like that. So you can basically go through that session, and it was more like an introduction to momentum investing. Today, hopefully, I wouldn't be going into much into the logic or of a particular strategy or how momentum investing works. That's not what we are going to do today. What we are going to understand today is what are the typical risks that might be associated with momentum investing. Right now, everyone thinks it's a holy grail, but that's not how it is. So we are going to try to understand how it can falter and how should we be prepared for it, what we can do to basically avoid anything that might take us a long way back and all those things. So we'll talk about that, and as Prince said, we'll have a Q&A at the end of the session to solve any questions. Over to you, Prince.
Great. Thanks, Viraj. So, Viraj, we will talk about the drawdowns in momentum and various crashes, be it the Indian context or the US market, and then we move on to next section, which we will be discussing.
Sure, that sounds great actually. Uh, so the first thing I wanted to talk is momentum investing is not a holy grail strategy. I have received like I've been I'm running this website called as momoindiascreener.in, and along with I have a newsletter called as momoindia.substack.com. I'm not trying to promote it or something, but I just wanted to give a background where I get a lot of questions on my email and Twitter from various people who are kind enough to appreciate my work and also ask a lot of questions. One thing that I observed is that many people think that momentum investing is something like a holy grail strategy. Uh, like if a stock is going up, then we buy it. The gist of momentum investing is if something is going up, we buy it, and whenever it starts going down, we sell it. This is like a very one-liner gist of what momentum investing does. And I get many questions wherein people think that it is a holy grail strategy. Like if we do that, then we are never gonna lose any money, or we are only gonna lose a little bit of our money. But that's not how it works. Last 3 years, like from 2020 to now, which is 2023, has been really, really, really good. There was an inherent bull market which was going on, which lifted like all the stocks. So most of the things that you bought went up. There was not really a big bear market or something. 2022 was something like a sideways market, I would say. There was some drawdown, but it wasn't like a very brutal bear market or where you would lose your sleep or something like that. So last 3 years have been very kind to the stocks that are that are in the listed universe. Everything that you bought might have gotten up and like rockets for most of the time. So last 3 years were really, really good. So don't try to think that just because there was an inherent underlying bull market and momentum investing did well with it, it doesn't mean that momentum investing will always be doing well. That's not how it works. So there are a lot of risks with momentum investing, and that's what I wanted to talk about a little bit. Uh, so as we all say, US is like the mother market here, and there have been a lot of studies in momentum investing around US markets. One study that I wanted to discuss about is around which was done by Wes Gray in the quantitative momentum book. Now, they have basically analyzed the data going back to 1929, not like 5 or 10 years before. They have analyzed last almost 100 years worth of data now. So they started testing on the data from 1929, and they have tested their own momentum strategy and various versions of it on that data set. They have adjusted it for everything. Like they have also included the delisted stocks. They have also adjusted for splits, bonus, and everything else that you might do to clean up the data. So they have really done it in a very good way. So what they have observed is momentum investing really outperforms the stock market, which is the S&P 500 in the US, but it also has a lot more drawdown and a lot more crashes. So when I say drawdown, what do you think a drawdown would be in the momentum investing in the US market? So the worst drawdown that happened in the US markets was between 1929 to 1932, the 3 years worth of drawdown and the biggest bear market that happened there. Uh, the strategy was down 77%. Just imagine 77%. When we talk about it in percentage, it doesn't look big or something. Like we say, okay, 77% है तो मैं तो से लूंगा. But it's not easy. Just imagine having a 1 crore capital and losing 77 lakhs of it. That's what 77% means. So that huge drawdown happened in the US markets during 1929 to 1932. Now, many of you might think, okay, it was way long back, like markets have changed a lot, and maybe something like that might not happen today. But the second worst drawdown, I'm just talking about the second worst drawdown in the momentum investing, happened again in the US markets during the period of 2000 to 2003. It wasn't long back, just 20-25 years ago, where markets were very much matured. They had electronic trading, information was abundant, and all those things. Even during that time, momentum investing got like the second worst crash, which was around 68%. And don't just think about it in terms of percentage drawdown. Also think about it in terms of the time that it took to get back. So going through a bear market for 3 years is not a small feat. So this was the second worst drawdown, and the third worst drawdown for them was in the 2008 to 9 bear market, which was around 63%. So if you see, all of these drawdowns were more than 50%. Actually, they were more than 60%, 63, 68, 77%. Two of these max drawdowns happened in the last 20, 25 years. So not that long ago as well. And they happened for like multiple years. It was not like a 6 month or 1 year drawdown like what happened in the COVID. It was for multiple years, like 3, 5, 6 years kind of things to recover from that drawdown. So it's not like, as I said, momentum investing is not something which is a holy grail strategy, and it goes through its worst drawdowns a lot of time. So this is the major risk in momentum investing, because what happens is we will commit to momentum investing, we will follow it in the good times. So when bad times come, we will abandon it and we will lose, like because it's going into drawdown, we will abandon it. We will not come for the recovery period that happens after the crash, and overall, over the long term, you might not get the returns that you see in the typical backtest of a momentum strategy. So that's why drawdowns and momentum crashes, which happen, are the biggest risk in momentum investing, because behaviorally we might just not, stick to the strategy. So this was about worst drawdown and recovery in the US markets. I also wanted to talk a little bit about Indian markets as well. Now, this is purely, there is no Indian mutual fund which goes back to 2005 or 2004. But there are a lot of backtests which happened from 2005 2006 period. So I'm going to talk on the basis of those backtests. So Indian markets also went through a lot of drawdown during these years. Now, just to talk about the most recent one, okay, not even going back 20 years. If you talk about the most recent one, 2018 to 2020 was one of the worst periods for the momentum investing strategy in the Indian markets. I don't know how many of you are active during the 2017 bull market, but 2017 was a really good bull market. And in 2018, after budget, the market started falling down. Uh, During the 2018 calendar year, the worst drawdown for a momentum investing strategy. Now, this there can be really different versions of it, but for a typical momentum strategy, the worst drawdown that went in the calendar year 2018 was around 30%. Now, again, 30% is, again, if we think in percentage terms, it seems like 30% to normal है, हो जाएगा करके, but it's not that easy. Like, imagine having 1 crore or 2 crore of capitals and losing 30 to 60 lakhs from it. That's not a small amount. And being and just consider doing that for 3 years. For 3 years, it will not recover as well. So you are down 30%, 20 to 30% for around 3 years on that capital. That's not something small. I have seen many people who abandon momentum investing during these periods. So in 2018, it went down around 30%, which is not a small amount, and it took around October 2020 to recover from that drawdown. So you hit the high of your portfolio in January 2018, and it only recovered to that high the next time in around September October 2020. So for around 3 years you were in drawdown. 3 years you're thinking कि भाई ये strategy work ही नहीं कर रहा है, मेरे को gain ही नहीं हो रहा है, because the market was sideways, the strategy was not working very well. It was just trying to make the best of what it was there. So it was very bad period where people were thinking 3 साल हो गया मेरा 2018 का high अभी तक breach नहीं हुआ है, so what should I do? Should I just not do it? It has stopped working. There are a lot of blogs also that came in which said that okay, momentum investing has stopped working now, and you should only buy high quality stocks. You should only buy Nestle's and HUL's and Infosys of the world, only buy TCS, only buy consumer stocks and all those things. These all things became very prominent during the 2019-2020 era, because they were the stocks which held up the market. But overall, the broader market, the breadth was very bad, and the strategy was totally in doldrums. So this is the risk of momentum investing strategy. In terms of drawdown and crashes, you go through that for a couple of years, 3 years, 4 years, and you start losing hope. That's where the problem is. And behaviorally, it is very difficult to stick to a strategy when it is in drawdown for multiple years. So you have to understand, like, this is not a small risk. This is a big risk on the terms of your portfolio and your behavior. Now, this was just the recent one. If I go back to around 2008, 2009, it was much more bad. So a typical momentum strategy or even markets hit the high of that time during 2018, during the start of 2008, sorry, 2008, during the start of 2008, we hit the high all most of the momentum funds that might have been, they were not there, but if someone was following a momentum strategy, the high would have been hit in the start of 2008, and it went into around 50-60% drawdown during the 2008 bear market, the whole great financial crisis. Now you might think the market did well in 2009, so maybe momentum portfolios also recovered during that 2009 period. I would say that yes, they recovered, but they didn't breach the high that was reached in 2008. The high of 2008 was breached only in 2013 and 2014. So just imagine being there for 4 years, 4 or 5 years in drawdown. Just imagine, like for 5 years, you didn't hit the high of 2008. So that's how big the drawdown was, and that's how long the drawdown was. Chart paths are like for 4 or 5 years, not having zero returns from that high, like what you lost in 2008 and not recovering that is a big thing. Now you might do SIPs, you might put more monies during that bear market, and you overall you might be positive, but just imagine like having that big of a capital and not reaching that high for 4 or 5 years. That is like a very very big risk in terms of momentum investing. So when I talk about all these things, these are called as momentum crashes. We typically call this like ye drawdown hua, wo drawdown hua, but these are what we call as momentum crashes. What a momentum crash is, basically it happens after a decent bull market. जब भी bull market हो जाता है, तो there is a period where the overall market goes into sideways or in a bear market, and this is a time where the momentum crashes. So momentum crash हो जाता है, the momentum in stocks gets crashed. So that's why momentum gets many much more worse drawdowns than the underlying index or underlying funds. So if you compare Nifty might have not gotten that big drawdown in 2019 or even in 2022 or similar years. But the momentum crash happens and it goes into a big drawdown. So so you this is the main risk with momentum investing. When there is an underlying bull market, you get very great returns. If Nifty does say 15-18%, you might do 40-50% in a momentum portfolio in a very good bull market year. But during bull bear markets, there is a very very high chance that Nifty might fall only 10 to 15%, while your portfolios might fall down like 25, 30, 35% as well. So you have to be very much aware of that to be able to go through these drawdowns, because after every bull market the recovery starts and you have to participate in the next bull market as well. So you have to go through these bear markets. I'm not saying be allocated to stocks all the time. Uh, there are certain instances where you can take cash calls basis on certain factors, but the drawdowns are a part and parcel of momentum investing. It is going to be very difficult to have a big alpha, but no drawdowns as well. That's not something that is going to work together. So this is how the risk of momentum investing involves, and you have to be ready for the crashes, the big crashes. So yeah, Prince, this was about the crashes and all those things. Do you have any more that you want me to elaborate on?
Yeah, Viraj, that's interesting, and trust me, this data which you brought amongst us was not aware. We had a perception that it's only one way, so that's big. So I mean, how we can avoid these crashes, and are there any parallel strategies which we can run during the bear cycles? I mean, how you position yourself, or maybe what could be an ideal way to get away with so much of drawdowns in the portfolio?
Yeah, so that's actually a very good question. So just to generalize there, basically, can we avoid the momentum crashes or not? So that is something that we want to understand, right? So there is no straightforward answer here. There is a yes and no answer, but I'm going to elaborate on that a little bit. So to quickly answer your question, can we avoid momentum crashes? I would say to a certain extent, yes, we can, but it's not going to be like 100% avoidance. To a certain extent, yes, we can, but there are going to be trade-offs with that approach. It's not going to be straightforward key. You will get the best of the things and you will also avoid the worst of the things. That's not going to happen. When you're trying to avoid a momentum crash, there are obviously going to be some trade-offs which are going to impact your strategy. Now, those trade-offs can be in multiple ways. One of the trade-offs, for example, can be going to cash on some parameter. So when does a momentum crash happens, right? It will mostly happen after a big bull market or once a bull market starts ending due to some kind of an event. Like right now, the war is going on. In 2022, there was Russia-Ukraine war. Now there is Israel-Hamas war, and all those things are going on, right? So those are some of the triggers. The Israel-Hamas war, interestingly, has not affected the markets as much as we thought it would yet. But the Russia-Ukraine war did affect them during the 2022 March, April, May, June period kind of stuff. So yeah, basically, uh, so what happens? Like this doesn't happen suddenly. There is a way that markets start crashing. The first thing that basically happens is volume starts going up or down. Depend like on the downside, there will be huge sellings on some volumes, or stock will fall on low volumes and stuff like that starts happening. So what you can do is you can start observing volumes of different indices or different stocks that you're holding, and maybe you can take a cash call basis on the volumes of the stock. So whether the stock is falling on a certain volume, you can say, okay, on low volumes, like on high volume stocks are started to fall. So basically, maybe the breadth is starting to get low, and maybe I should get out of my equity allocation or the momentum stocks that I was into. That is one of the approach. Another approach is basis on volatility. So when I say volatility, it can be as simple as observing India VIX, or it can be a little bit complicated, like comparing the standard deviation of different indices over the past year. So for example, one thing that I try to keep track of is the standard deviation of all the indices over the last 1 month and last 1 year. So, for example, if in the last 1 month the standard deviation of a particular index goes like higher than the standard deviation of the whole last year, then it means that volatility has started to increase. And when volatility increases, it mostly happens on the downside. It doesn't, it just because volatility is increasing doesn't mean it's only going to happen on the downside, but most of the times it will happen on the downside. So whenever volatility starts increasing, it means that there is a very high chance that markets are starting to going down. Or you can also keep track of some other things like how many stocks are above their 200-day moving average or 50-day moving average, or maybe a 100-day moving average, and other filters like that. So these are some of the things that you can start keep tracking on, and you can define by yourselves. Okay, suppose if 60% of the stocks start going below 200-day moving average, or 50% of the listed stocks are below their 200-day moving average, I will start moving to cash. Or if majority of stocks have started going down on volumes, I will start moving to cash partly. Or if the volatility is increasing basis on the standard deviation, I will start moving to cash partly. So these are certain parameters that you can use to start moving to cash, which is one way to avoid these big crashes. But again, as I said, there is always a trade-off with this approach. The trade-off is that crashes don't happen every year. Crashes are rare. So momentum crashes happened once in 2008-9, once in 2018-19, and once in 2020. So these are rare. These don't happen every year. These don't happen as frequently as we think. So but corrections do happen every year in the markets. Crashes don't happen every year in the markets, but corrections do happen. So what happens is when you start taking these cash calls, partly cash calls on basis of volatility or any other parameter that we discussed, uh, they will give you false signal during corrections as well. So if you had followed any of these signals, you might have gotten a signal to move to partly cash maybe last week when the market fell down a lot, or maybe during the 2022 Russia-Ukraine war bear market, which was like 4 or 5 months at the most. So those were corrections; those were not very big crashes. So you might have got these indicators might have given you the signal to go into partly cash during those times. So what happens is during the start of those corrections, you will go into cash and you will feel good, like yes, I have moved to cash, I haven't gotten that big of a drawdown in that correction. But what happens is when markets start to recover, you don't get in as fast as possible as well. What happens is when the bull market starts again, uh, when the bull market starts again, uh, your full entry into the stocks also happens very late. Thereby, you're losing what you lose is the recovery period, the returns that you get during the recovery period. So that is what happens. But during a big crash like the 2020 COVID crash or during the 2008-9 bull market, bear market, you go to cash early and you avoid the whole momentum crash as well. So as I said, there is a trade-off here. What happens is if you start taking cash calls on basis of these indicators during very big bear markets like 2008, 9 or 2020, you will come out very nicely. You will avoid most of the drawdown. You will have very good performance by not getting into the big bear markets. But during most of the corrections during other years, what happens is you will start getting whipsawed a lot. You will go into cash and then quickly again come back, again go to cash, quickly again come back. This is what will happen during those corrections as well. So that is the trade-off that we are trying to do. So what is it? So to summarize, what is the trade-off here? The trade-off is that just to avoid a big momentum crash, we are okay to go into cash and having whipsaw during the normal corrections. So this is the trade-off that happens. And what is the drawback of this trade-off? The drawback, the big drawback is that your CAGR reduces a lot. Just because you are constantly getting whipsawed during corrections, you go into cash and you go back into full allocation. Then again go into cash and again go back into full allocation. What happens is that your overall CAGR for your portfolio starts going down because of those cash calls. Because you're not fully participated into the recovery rally, you don't get as much returns as someone who might be in that recovery rally as well.
This space was downloaded via spacesdown.com. Visit to download your spaces today.
So this is what happens. This is the trade-off that you need to take when you are taking cash calls basis on certain filters. Because many people will ask me what I do, I will just answer that right away. So what I basically do is I don't take cash calls on basis of any of the indicators. So I'm always fully allocated to my equity allocation. If there is a stock in my screener, I will always buy it. I don't take any volume based or volatility based or certain MA based cash calls. Never. I don't do that. Only if there are no stocks in my screener, that's the only when I go to cash. Whenever, so for example, if I have 30 stocks today and tomorrow in the screener, there are only 25 stocks, then I will go into cash for the five stocks basically. If there are zero stocks in the screener tomorrow, I will go into 100% cash. So that's the only time I will go into cash for my personal strategy. I don't take any cash calls on the basis of any of volatility or volume or number of stocks, etc. The reason, again, everyone will ask me, why do you not take cash calls if the drawdown reduces? Because I think crashes are rare in the market, corrections are frequent, and I'm optimizing for risk adjusted returns in I'm not just optimizing for risk adjusted return, I'm also optimizing for returns in the whole. Like I want my CAGR to be good on my equity portion. That's why I opted for momentum investing, right? That's why I kept my asset allocation in place because if something crashes, I'm not my 100% of net worth is not allocated to this momentum strategy. I have my asset allocation in place, so I can take this cash, so I can take this risk in the momentum investing, and I don't need to go into cash calls frequently with all these corrections and other stuff. So that's why I do it. Again, the answer can be different for everyone, uh, but we'll discuss that later. But yeah, this is my answer to the common questions that I usually get on Twitter and my email as well. But yeah, Prince, over to you.
Yeah, Vipinji had a hand raised. Vipinji, you can ask now.
Uh, Hi Viraj, I'm Vipin Gupta, CA, trying to learn the nitty-gritty of the market. And I have a question for you. Do investors need to focus on quality of a company instead of micro and macro economic factors? Can you please answer that?
So what I would say is, if you're asking from a fundamental perspective, I I don't know if there is a right answer to this question. I think we should. I don't do fundamental investing, but to answer only in terms of momentum investing, I don't do that. Whatever comes in my screener, I basically buy. I don't check like if this company is fundamentally strong or if this company. I don't even see like what products it manufactures or something. I just if something comes in my screener, I will typically buy it without thinking a lot. If it goes out of my screener, I will sell it as well with with no emotion as well. So that's how I follow it in momentum investing. If you're asking it purely in terms of fundamental, uh, I have very little knowledge of that, so I'm not the right person to answer it. But typically, yes, I think you should obviously uh, think about the quality of a company rather than the macro and micro factors, but only in terms of fundamental. Again, I'm very bad at fundamentals, so I don't don't trust me
Yeah,
on that. In course of momentum
yeah, yeah.
investing, I don't think you should. You should just basically buy whatever comes in.
Yes, I can understand. And what would be your advice to some investor during these kind of turbulence time when one day up 3 day down, then again Monday up. So, what a investor should do and stay calm in these kind of time.
The best way is to, like, if you have a strategy, just stick to it and turn off your screen. That's like the best advice I give, and I give that advice because I follow it. I typically see markets very less during when they're active, like from 9:30, sorry, 9:15 to 3:30. I'm not very active right now in the markets. I do observe them in between, but the screen is not on all the time. So behaviorally, that's better for me. And if I have a strategy, I basically stick to it. That's what I would say. Like, I don't try to divert from my strategy. That's the only thing I can say. There is no, as I said, there is no holy grail answer here. You have to just find something that works for you and just stick to it. I guess that's the only answer I can think
Okay,
of.
okay. Thank you for that. And what kind of parameter you put up in screener while getting the momentum stocks? What kind of parameters?
So I've recently published a blog on my newsletter, momoindia.substack.in, because if I start telling it here, it will take another 10-15 minutes. So it's better. I've written every step that I do to get to my screener, like what all steps I follow for my momentum rules. I've published in just on this Wednesday or Thursday, something like that. I've published that blog. So please do read that blog. And if you
Mm,
have any questions, you can email me or reach out to me on Twitter. I will answer your questions.
mm. Thank you
No
very much.
problem.
I'll definitely go through it. Thank
Thank
you.
you, Vipinji.
Yeah.
So we got one more speaker, Madhu. Madhu can unmute and ask his or her question. Madhu, you are still on mute. Any questions on your part? So Viraj, like I also, I mean, I'm not sure whether I asked the same question last time or not, but for the benefit of the audience, as far as momentum strategy is concerned, so do you think when the size, maybe the size of the capital grows, then there are some challenges, and if there are challenges, how we can overcome from the angle of momentum investing?
So when we talk about retail investors, I don't think they are going to ever reach a size where it will be a problem for them doing momentum investing. So I don't think until 50, 100 crores there is going to be a problem at all. Like, you can go into small caps, you can probably make your portfolio bigger, say 30, 35 stocks or 25, 30 stocks, and you can go until 50 to 100 crores easily. I don't think there is going to be any problem with 50 to 100 crores of capital at all. When you start crossing that, yes, you will have some problems. So when you reach that portfolio level where it is at 50 or 100 crores, that's when you can start thinking about, okay, what can I do uh, to make it more robust in terms of, you can add more filters in terms of volumes, or you can go to only like bigger market cap stocks and avoid like very lower market cap stocks. You can start taking cash calls and stuff like that at that portfolio level. But if you're like 35 lakhs, 50 lakhs, even like a couple of crores, I don't think it's going to affect in any way materially to the momentum strategy as such. And just to extend that on a bit, one thing that I observed people discussing a lot is a lot of momentum funds are getting launched, a lot of NFOs. Recently, today or yesterday only, I read about Quant Mutual Fund also launching a momentum fund. Samco recently launched one, and there is a lot of other momentum funds as well, like the Tata Mid Cap, UTN Momentum, etc. So many times I get questioned, like, with so many funds getting into momentum investing like this, will it like take out the alpha of the strategy? I would say no. The amount of AUM that is there in these funds is very less. It's nothing compared to what is in other active strategies and index funds. So I don't think the current AUM, or even if it grows like 10x from here, it's going to affect the momentum strategy materialistically. Second, I would say that if you're a retail investor, it's much better for you. Like, if you're doing this on your own DIY, it's much better for you uh, f- in terms of getting the alpha, because you can go into much smaller caps, like small caps, micro caps, which these funds can't go into because of their SEBI regulations, as well as the veracity with which they can go in and out of the stocks. It will be difficult for them. So they would typically not go into very micro or small caps where you might get some more alpha. But even if they stay in the mid and large caps, I don't think the alpha is going anywhere. And if you are if it is going to be very difficult for you to stick to a strategy on your own, I would suggest please go through a mutual fund or through a PMS who follows like a pure momentum strategy. That's a better approach if you think you're not going to be able to stick to it. But if you have like, I don't want to say this word, but if you have the guts to stick to it, which is a very crude word, uh, for over 10, 15, 20 years, then I think DIY momentum strategy will still have a lot of alpha remaining in it, and it's going to be fine. I don't think the current AUM or even 10x of that AUM is going to hamper any momentum performance.
Great. And for our audience, like the previous session has been pinned to the spaces, so those who missed can surely listen to that. And now the floor is open for questions. So in case you have any questions, you can directly send in a speaker request, or you can simply type in the questions in the comments. So Viraj, apart from that, like these, obviously, the recent 2 3 days of market, small market correction, you cannot term it as a correction broadly, but again, so if the system says moving into cash, and then again the system shows the setup, so don't you think that this too much of, in one sense, a churning, basically you book your, I mean, basis your stop loss, you come in cash, and then you again deploy the money, and if the market still has that volatility, so that has a great impact as far as like the long term CAGR is concerned. So how, I mean, you can, maybe if not, and on the top of that, like the screening criteria, right? So that remains fixed, or in those times, you I mean, change some screening criteria so that, and relatively more strong names come in your screener, or is that so? I mean, I know the question maybe is a little bit confusing, but I think you get the gist of it.
Yeah, so first of all, about the screening criteria, no, my screening criteria is fixed. I never change it. I might add a filter or do, but that will be like for forever. Like if I add a filter, it's not gonna change during a bear market. Whatever filters I use are gonna be same in bull and bear market. It's not like I'm changing filters during bear market and during bull markets. The filters are same. And to answer your first questions, so in the last week there was a lot of turmoil. The market went down like 10, like at least my momentum portfolio intra-week drawdown was around 10%, 10, 12%, something like that. And then it recovered, and right now my drawdown is only like 2 or 2.5%. So it recovered fully this week. So it did go through 10, 10, 10, 12% drawdown, something like that, and now it recovered as well. I didn't do I first of all, I don't have any stop losses in the system. I just rebalance monthly once, and whatever stocks gets churned, I basically churn them. During very high volatile periods, I might switch to weekly rebalancing, but that's pretty much it. I don't have any like specific stop losses on my stocks or something. So what I want to say is, churn is where the alpha of momentum investing comes in. If you don't churn, you will not get into strong stocks and you will not get rid of the weak stocks. So churn is very important for any momentum investing strategy to generate alpha. Churn also happens in the index. Churn also happens in most of the active funds. Churn also happens in most of the index funds. If you see, at least two Nifty churns around like, I think 20 or 30% every 3 or 4 years, something like that. So there is a churn in every index, in every strategy. The rate of churn might be different depending on what the strategy is, but churn is very important because churn is where you will get performance. Unless you churn out your weak stocks and get into strong stocks, you're not gonna perform. So churn is part and parcel of a momentum investing strategy. It is a cost that you have to pay. The cost that you might pay on churn can be different depending on whether you're doing weekly rebalancing or monthly rebalancing. So it's up to you. But I think churn is very important. Without churn, we will never get alpha.
Fair point, Viraj. So, Viraj, you were talking about the rebalancing period. So, let's talk more on that. So, is it like why you have decided to churn it once a month, and what could possibly the other rebalancing period which people use, and maybe the pros and cons of all the rebalancing periods in your view?
So this is a very tricky thing. So rebalancing is something that you can do either weekly, monthly, quarterly, 6 monthly. So most of the index momentum funds, which we have like the UTI Momentum Nifty 200 fund, that rebalances every 6 months. So they churn only once every 6 months. There are, I think, certain rules where they might churn in between if there is some criteria. I forgot about it, but there is some criteria where they might do a mid 6 month churn as well, depending on that very strict criteria. But otherwise, by default, they do 6 month rebalancing. Most of the US funds also do quarterly or 6 month rebalancing. I personally do monthly rebalancing. Many people on that I know do either monthly or weekly rebalancing. Now, small case has a lot of momentum portfolios. Most of them do weekly rebalancing. Very few of them do monthly rebalancing. So it's all over the place. Now, about pros and cons, I think it's all about costs. The more you churn, the more you rebalance, the more costs you have to pay. In India, we have to pay STT, we have to pay GST, we have to, if you don't have a zero brokerage broker, you have to pay GST, you have to pay brokerage plus GST, you have to pay exchange transaction cost and all those things. So the more you churn, the more you have to pay your fees to the market and other government authorities. So it needs to be a balance. I personally think quarterly or 6 monthly rebalancing is waiting too long, because whenever market starts crashing down, we need to rebalance immediately. So monthly is a good midpoint. That is what I think. I personally stick to monthly rebalancing, but weekly rebalancing is also fine. The only drawback of weekly rebalancing is having higher costs. Again, they are not very high, but definitely a little bit higher, which might cost you 1 or 1.5% in CAGR over the long term, which again is not a small number. 1% or 1.5% CAGR over 10, 20, 30 years amounts to a very big change in the end portfolio value. So I think rather than looking onto the cost, you should do what will help you stick to the strategy. If you think doing a weekly rebalancing might help you follow the strategy for the next 10, 15, 20 years, then please stick to weekly rebalancing. If you think you can do monthly rebalancing and stick to it irrespective of what the market does, then please stick to monthly rebalancing. What I personally follow is, for 90% of the times, I am always default to monthly rebalancing, but during high volatility periods, I will switch to weekly rebalancing. This is what I can stick to. This is something I can follow for a longer period of time. So that is why I've chosen that for me. But you can choose what works for you. Anything between a week and a month or a month and a half is fine, as long as you can stick to it for the longer term. So that's where behavior will come in. Don't like in the last week the market went down 10% intra week. I didn't go and sell my stocks in between. In between, many people sold their stocks just because they started hitting their stop losses or because the market was falling. So because I knew like my strategy is robust and the volatility wasn't very high enough for me to switch to weekly rebalancing, that's why I didn't. But yeah, do whatever, just to summarize, do whatever works for you over the long term, because that is more important than trying to optimize on these small nuances. But both weekly and monthly rebalancing works. I would say don't go for quarterly or 6 monthly, because that is like too long a time in your DIY portfolio to churn your stocks.
So, basis the back testing which you explained previously, be it the US markets or the Indian market. So, Viraj, what do you think? Like the pain periods which you explained, the drawdowns was like too much, right? So, if that situation comes, then right. So, during that, I mean, prior to that, coming in cash is one thing, but if you are into middle of it, so what a momentum investor would be doing in that period of time when the filter or the screener would be throwing very less names. So, is there any way to change the strategy, or I mean, if you can explain around that?
So there are approaches that many people around the world have started incorporating. So one that I wanted to highlight is there is this book called as The Conservative Formula by Pim Van Vley, if I'm spelling it rightly. Sorry, pronouncing it rightly. So there is this book called as The Conservative Formula. It's a very good small book, very nicely written. He has explained it in a very simple manner, like a common reader might be able to, who has no knowledge of how anything works. He has explained it very nicely there. It's a good book to read. I have read it a couple of times. So what he explains is kind of a multi-factor approach which can help reduce drawdowns, as well as it might help you in terms of this momentum crashes. So what he does is, I will explain his whole strategy in like 2 minutes as simply as I can. So what he does is he first ranks his stocks on the momentum factor. So he takes all the stocks which are which have given the best returns in the last, say, year or so. Then he takes the most low volatile stocks in the last year on the basis of last 1 or 3 years volatility. He will calculate the least volatile stocks. He will rank both of them on those ranking order. He will add those ranks to get a combined rank basically. So for example, if let's say ABB India is, for example, say a rank 1 on the momentum factor and is at rank 20 on the low volatility factor, then he will add those ranks. So it will be 20 plus 1 equal to 21. So that is the final score of that strategy. So we'll do it for all the listed universe, and then he will sort it on the combined ranks that he got. There is one more thing that he used, which is the shareholder yield, but that is a little bit complex to explain right now. So basically, he also uses the shareholder yield as the third parameter to rank, but we'll just ignore that for now. So what you can do is you can take these two things, lowest volatile stocks and the momentum ranks, combine them, get a combined rank, sort them on those ranks, and then buy the top rank. So what happens here is you are trying to buy the best momentum stocks, but also those stocks which are a little bit low volatile. He did a backtest of the same strategy from, I think, again 1926 or 1929, something like that. He did a backtest of this strategy from then until I think 2010 or 2013, something like that, when his book came out. So he did a backtest. What he observed was that the drawdown reduced a lot with this strategy, first of all, and the performance was on par with the momentum strategy as well. So this is something that you can incorporate in a strategy, which is a multi-factor approach. Uh, Again, it has its ups and downs because it will not give you the highest returns during the bull markets, nor it will give you the lowest returns during the bear markets. So it's something, there is no trade-off here, but this is something that you can start doing if you are worried about how it will work, or how can I avoid momentum crashes and stuff like that. Now, we don't know how this works in Indian market. Actually, sorry, that is wrong answer. We actually know how this works in Indian market. There is a paper by Rajan Raju. You can find it on SSRN. He has tested this strategy on the Indian markets. It has worked very well, but I don't think it has beaten the momentum factor. It has definitely, this strategy has definitely beaten the normal market indexes, the typical mutual funds that you might have, where you might get a decent index return. So this strategy has definitely beaten them. I don't think it has beaten momentum factor as such in India, at least. I need to check that once again. But this is another approach, like just to fan out a little bit and think what you can innovate or what you can do differently. This is a multi-factor approach. Now, here I only talked about momentum and low volatility. When you say multi-factor, you can involve other factors like beta. You can calculate the beta of a stock, and then maybe you can start incorporating ranks on beta, and you can combine, say, volatility, beta, and momentum, get a combined rank, and then sort on it. Or if you want to have, say, some other factor like uh, average of sharp returns over the last year or something like that, or you can have other factors are there like a small cap factor. So you can probably use the small cap factor to do this in the uh, small cap universe, or you can have a quality factor as well. So you can only add the quality stocks. You can rank stocks on momentum, you can rank stocks on volatility, and then you can rank stocks on quality, then get a combined rank and then sort them out and then do your strategy. So there are variety ways of doing a multi-factor approach. Again, just because there are variety of ways doesn't mean that it will always work. You will have to see what works, what doesn't work. I haven't personally tested all of this, but I don't think I'm right now in the mindset where I will do this multi-factor approach. I'm very much satisfied with the momentum factor. I do a sharp return based ranking. But yeah, these are some of the ways that you can definitely look around and try to create your strategy.
So, Viraj, you discussed about too many funds are coming. So, we were discussing about the future of momentum investing. So, I mean, take a scenario like, correct me if I'm wrong. So, if somebody, say, 10 people are following the momentum strategy, right? They would have their own strategy, but again, the strength or the names would be common, or it would be, just to for the sake of. How it goes, Viraj. If the names are common, then obviously, so if the funds and the good investors are coming in, so definitely when they would be entering, there would be strength, there would be upward movement. And say when all the hands bases their strategy, and get out of those stocks, at that point in time, liquidity can be an issue if more participants are invested in common names basis strength. So, any thoughts around that, Viraj?
Yeah, sure. So obviously names are going to be common. I wouldn't say they're going to be 100% commons, but obviously there is going to be some overlap when you're following a momentum strategy. If you compare different mutual funds, at least, yes, there is going to be some overlap. Uh, Either way, like if they're active or index mutual funds. On DIY side as well, there is going to be some overlap, but I don't think it's going to create a big problem as such because uh, see, on DIY basis, I would say there will be some overlap, but it will be much easier for you to get out because your quantity wouldn't be that big. So mutual fund owning say a 25-30 crores of a stock and getting out is a lot different than you owning say a couple of lakhs or 5 lakhs worth of stock and getting out. You can easily do it with a limit order in say a couple of minutes or maybe a 5-10 minutes at the most. A mutual fund owning 25-30 crore stocks in a micro cap stock, it's going to be very difficult for them to exit that in a couple of minutes. It's going to take them some time, or they might have to do some bulk deals. Uh, if it is a large cap or a mid cap stock, again, it's going to be easy for them to exit a 25-30 crore position. That's not going to be difficult. So I would say, yes, there is going to be a lot of overlap, but but as a retail investor, I don't think you have to worry about it. It's going to be very straightforward. If you're investing into mutual funds, also, you don't have to worry about it because they are very well versed with what to do here and they will take care of that. Uh, Also, if you compare mutual funds and your DIY portfolio, then the overlap is going to be very less. The reason being, you might get into stocks which might not be qualified for them. So, for example, for me personally, the the criteria for the volume criteria for entering a stock is 1 crore in rupee terms, okay, not just volume like number of shares traded. In rupee terms, my volume criteria is the medium volume over the last year should be 1 crore. So if suppose there are 250 trading days in the last year, for example, then at least on half of those days, the stock should have traded the value of the stock traded on a particular day should be greater than 1 crore. That's my volume criteria. For a mutual fund, that might be higher. So they might not get into stocks which I might get into for some reason. The only reason is because my AUM is going to be very less, my personal equity is going to be very less. So I can basically get in and out of those stocks quite easily, while many mutual funds cannot. The most recent example that I would like to give is Adani. Like during January, February, Adani started hitting lower circuits a lot. I was able to get out of it in 2 or 3 days, like easily, with limit orders. But many people, many small cases, many PMSs were not able to get out of Adani stocks as well. Many mutual funds were not able to get out of Adani stocks until very later. So that's where you having a small portfolio might make sense. But yeah, to answer your question directly, I don't think there is going to be a lot of overlap between a DIY portfolio and a mutual fund portfolio, but there is definitely going to be overlap between different mutual funds. But it is not a sign of worry because there are going to be similar stocks who go up in a single time during a bull market. The overlap is fine, and we should be fine with it. That's not a risk, as is what I think.
Right. So one last call for our attendees in case they have any question. And Viraj, my last question to you is like the obviously you're not concerned much about your system tells you that. So broadly, how you're looking the current market. I mean, how your system is saying whether after a couple of days of weakness the strength is back or there would be more pain down the line. I mean, what your system says broadly about the market outlook.
Uh, so what I would say is right now I'm fully allocated. My system didn't point me to switch to weekly rebalancing because the volatility wasn't as high as I thought. The system is fully allocated. My next rebalance will happen on 1st of November, which is like in 2 days. So I think there are enough stocks that will get in the screener for me to be allocated fully. uh, I keep a track of one thing that I keep a track of daily is so there is this Nifty 750 index, which is the Nifty Total Market Index. So I keep a track of percentage of stocks above 200-day moving average from that index. There are in total 750 stocks in that, and I keep a track of that parameter, like how many percentage of stocks from that index are above the 200-day moving average. So what happened in this week was on the worst day, which was on the 26th of October, which I think was Sunday, Saturday, I think Wednesday or Thursday, something like that. There were still like 76% of the stocks in that index were still above 200-day moving average. It got up in on Friday closing, which is 27th October, around 79% of the total stocks of the Nifty 750 index are still above their 200-day moving average. So I don't think this is the time to worry about or something. This I think is a correction. Again, I can be wrong. This is a correction that is happening, which might linger for longer in the next week or in November, December. This might just go more into deeper correction as well. But overall, at least until now, I don't think the market outlook is that bad. The breadth is fine. My system is giving full allocation right now, so nothing to worry about.
Great, thanks, Viraj. I think no more questions from the attendees. So, Vipinji, any question on your end, or shall we wrap up for the day? I think Vipinji also had his questions. So, Viraj, thanks again for joining us and sharing your insights. Really helpful. I really appreciate your clarity and your system also. And best wishes for that. And definitely, it is going to be helpful for our audience. Those who join late can surely listen to the conversation once I upload it over my YouTube channel. And thank you so much, Viraj. Anything to say before we close?
Nothing. I just wanted to say, reiterate what I said before. Like momentum is not a holy grail strategy. It has its downsides and risks. So be aware, keep your asset allocation in mind, and then dwell into it. Again, Prince, thank you for inviting me. It was really wonderful talking about this. Thank you so much.
Thanks, brother.
This space was downloaded via spacesdown.com. Visit to download your spaces today. 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 Download your spaces today.